see, here's the thing is cap rates are very important, yet they're not important. They really help us determine the value of a property, yet they can be misleading depending on the type of property you're buying. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, our sponsor for the show today is Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, and they were recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through their investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. Look, there's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. Hey, welcome back to Pillars of Wealth Creation. I've got Matt Jones with me for another Hump Day Hustle. I, of course, am Todd Dexheimer, the host, and Matt and I are excited to talk to you today. We're going to be talking about some cap rates today. But before we get started, Matt, happy Thanksgiving. I hope your Thanksgiving was absolutely excellent and we were able to celebrate what we're thankful for, because all of us are thankful for some amazing things that we've had in our lives. And I don't care if you've had some devastating things in your life. I do care, quite frankly. I'm sorry if you have, but you have had amazing, amazing things in your life, and there's always stuff to be thankful for. And we need to stop, think, and reflect about that. So, Matt, what's new with you? Anything new, anything exciting, or lessons learned?
Well, something new. I'm planning my first 1031 tax exchange with one of my properties, so I'm excited for that to put off paying some of the taxes from the capital gains.
Perfect.
And then how about yourself? Anything new or exciting with you?
Well, I got a follow-up question, Matt, because
Yes.
Following on the theme of Thanksgiving, Matt, what's one thing that you're very thankful for right now?
I'm thankful for, I guess, the education that I've had in real estate to open my eyes. Otherwise, I would be just working at a job thinking that I need to work until I'm 65, and then hopefully I can retire off my savings accounts and such. But so I'm just really thankful that I found a better way, a different way to live my life.
I love it. I love it. Cool.
And how about yourself? What are you thankful for?
Man, there's just so much to be thankful for, but I think first and foremost, I'm absolutely thankful and blessed with my family. My wife, she's amazing. And then I've got, two just absolutely awesome kids. So excited for and thankful for them. It's a blessing, and absolutely same thing as what you said. Excited and thankful that real estate, and I don't want to call real estate the thing that I'm thankful for, but just finding that entrepreneurial path that I've found to be able to understand there's a different way and a way to set yourself up for success and happiness without being tied to necessarily that W-2, be necessarily dependent on everybody else, but be able to create your own path and create your own reality.
Absolutely.
So, yeah, for sure. All right. So today's topic, what are we talking about?
Cap rates, also known as capitalization rates, but cap rates for short.
Yep.
So cap rates are one metric for determining how well a property is performing. And, it's not the only metric, but I think it is an important one, just sort of as a snapshot to see whether a property is worth it or not.
Yep.
And to calculate it, it's actually pretty simple. So you just need to know two figures, the net operating expense, or net operating income rather,
yep,
as well as the value of the property. So like how much it sold for last, perhaps. And the net operating income is you take all of the income that it has on an annual basis, and then you minus out the regular operating expenses. And so that involves like taxes, insurance, property management fees, repairs, maintenance, other miscellaneous expenses that you might have. And then what you have left over is the net operating income.
What about your mortgage?
Mortgage is not included in this. You don't include that in this calculation.
What about big expenses like a roof or capital expenditures? Are you including that?
No, I don't believe so. Because those would be separate.
Yeah, so that's I kind of set you up. That's a kind of a trick question. It really honestly depends.
Hmm.
And so some people say yes, we include that. Some people say no. When I'm calculating, of course, on the buy, I'm including a capital improvement line item of $300 per unit per year. When I'm going on the sell end and I'm trying to promote it, I'm taking out the capital improvement $300. I'm not including that in. And I'm saying, hey, we're selling this thing at a 5 cap or 6 cap or whatever, but we're not including those numbers in. So, it's kind of a trick question.
I suppose it depends on who's operating the property and what you're trying to do with it.
Yeah. So obviously, as you can see right there, cap rates are sometimes a little bit misleading. That, of course, the $300 is not going to change it drastically. But sometimes we can manipulate them a little bit to kind of change the cap rate.
Mm-hmm. Yep, that makes sense. So anyway, you take the net operating income and you divide it by the value of the property.
Gotcha.
Perhaps either what it was just sold for or what you're trying to sell it for, and that will give you what the cap rate is.
Yep. And if you know the cap rate, we could figure out if we have the cap rate in the area, the prevailing cap rate. If we know that a typical property sells for a 5 cap, we can figure out, if we know the net operating income, we can figure out the value of that, right? By multiplying those. So
exactly.
Awesome. So
I'm wondering how do you determine what a good cap rate is for an area or for a property? Big question.
Yeah, big question. So let me just quick go over because here's the thing is cap rates are very important, yet they're not important. They really help us determine the value of a property, yet they can be misleading depending on the type of property you're buying. So where cap rate is, I think, so cap rate's really important if you're in this business on understanding what the value is or what the future value can be. Now, when we're doing value add means we're doing some sort of typically work. We don't always have to do work, but we're doing something to change the net operating income of the building to increase it. Right. So when we're buying on value add, we might not be nearly as concerned about what the going in cap rate is. We might be willing to buy a cap rate of 4% in a market that sells for 5% because we see that there's a lot of upside. So sometimes we don't care as much going in as we do on the back end of the selling and trying to understand, okay, what can this property be worth? So cap rates are still important. And when we have to understand what our strategy is, where cap rates are really important is if you have just a yield play property where the thing's already up and running, everything's running right. Well, we want to buy it at market cap or potentially above market cap, right? So we're buying it below value. That's our goal. So that's where cap rates are really important if you're buying a yield play. So it's going to determine our value, right? So I guess that's the biggest importance. So go back to your question. What was your question again? I want to make sure I answer it right.
How do you determine, what a good cap rate is for an area or for a specific property within an area?
Yeah. So first of all, it's got to be based on your definition of what a good property is and what a good cap rate is, what good returns are. But how do we determine what properties are selling for? And if we're even getting a good deal, an average deal, or a bad deal, is we want to know what the cap rates are in the area. So there's a couple ways to do that. There's research tools that typically you have to pay for, like Yardi Matrix, like CoStar, Reese. There's a bunch more. So those are tools that'll give you the cap rates in the area. There's also brokers and broker reports that can give you cap rates in the area. Now you got to be a little careful with them, because if they've got a reason to manipulate or to maybe not tell 100% of the story, you have to be cautious, right? If they're potentially looking out for their interest, you have to be cautious. So if you're asking the broker that's listing it what the cap rate in the area is, and they say, well, it's about a 5 cap. Well, does about a 5 cap mean it's a 5 cap, or does that mean it's a 5.9 cap? That's still about a 5 cap. So, and then I would say the next is appraisers. So having good appraisers on your team is really important, and actually mortgage brokers too. They've got all the research data. They know what properties have sold. So that's why having your team in place is important, because it's a couple of quick phone calls, especially if you don't want to pay for, if you don't have a subscription to any of those that I've been talking about, like Reese and CoStar and Yardi, and we don't have those. Well, who do you lean to for advice? So if we can go to the broker, appraiser, property manager, and mortgage broker, we can ask all of them and survey them, and they all say the cap rate in the area is 5%. Well, then we know it's a 5%. If they're all over the board, well, then we got to probably dig in and do some more research, get a report from one of them. So yeah. Help.
Yeah, that makes sense. And I get the sense that if a particular property's cap rate is much higher than what would be typical for that kind of property in that area, then it's either maybe it's a great deal, or maybe there's something really wrong with the deal. Right.
Yeah, I mean, or it could be that the numbers are being misrepresented. Maybe our expenses are way out of line, right? So maybe we have a seller that is self-managing, so they're not putting any management expense in there. They're self-managing and they're doing a lot of maintenance kind of on the cheap in-house, or they're just not doing a lot of maintenance and they're skipping the maintenance. So that's not an expense item. So we got to kind of look for things like that. When I determine my net operating income and the cap rate, I'm not necessarily relying solely on the seller's numbers. Do I look at them? Do I lean on them a little bit? Yes. But if I look at a number and go, I cannot manage this property for 2%, there's no possible way. Am I going to put 2% in there? No, I'm going to put 3.5 or 4 or 3 or whatever I can manage it for. If I look at it and go, man, they're spending $175 a unit on maintenance, that's not even possible. What, am I going to put the $175? No, absolutely not. I'm going to put my number in there that I know and that my property manager and I have talked about. So we have to be realistic. So I would say, yeah, cap rate, if you're able to buy it at a nice high cap rate. So again, market cap's at a 5, we're able to buy it at 7. You've got to go, okay, what's wrong with our property? Why, especially in this market, today's market? Now, if it's a market like in 2008, 2009, 10, where people are desperate, the reason might be because they're just desperate. They just want to get rid of the damn property. So.
And then it's a great deal.
Then you got to buy it. Yeah.
So how do you determine whether a cap rate that you're being told is accurate? Like,
again, the survey, if you've got 4 people telling you completely different cap rates, well, then we have to dig in deeper. If you got 4 people that are telling you very, very similar cap rates, 5 to 5.25, well, we know we're between 5 and 5.25, but the reports that I talked about, the paid for reports, those are accurate. I mean, they've got a lot of data and you can pull the data properly. If you're doing the data pull yourself, well, just make sure that either way, I guess, if you're doing it yourself or somebody else is doing it for you, a broker, real estate broker, mortgage broker, appraiser, property manager, they all probably have subscriptions to at least one major service provider in the market. Make sure their data that they're pulling is like kind properties that fit. Again, like I said, if they've got reason to potentially manipulate the numbers, you've got to really make sure that those numbers are accurate. So we want to make sure the comps are comps. We want to make sure there's not better comps to be pulling from. And even if we're doing our own research, like, are those the properties that we should be actually pulling comps on? And it doesn't necessarily mean that's like, sometimes the property right next door is not that accurate of comp. Maybe that thing's super nice, brand new, or maybe it's super old and run down, and being totally mismanaged. Well, that's not a comp. If it sold 2 years ago and it was a foreclosure, a year ago and it was a foreclosure, well, that's not a comp. So just because it's right next door doesn't mean it's a comp. It might be 2 miles away and still be a comp. But if it's in a totally different class A neighborhood, and I see this in some marketing packages by real estate brokers, not all the time, but sometimes, they'll use a property that's in a completely different area. And it might even be close by. It might be only a half mile away, but they're using a comp that's on the other side of the railroad track type of thing, on the other side of the freeway, where you go, well, that's all kind of like A-class stuff. And this property is in the C-class neighborhood. Like, these aren't comps, but yet they used it because maybe they're the similar age buildings or something like that, and they're close to each other. If you don't know any different, you're going to get a bad reading of the market.
And how do cap rates differ between the classifications of properties, A versus B, C, or D?
Yeah, very good question. I mean, our cap rates are going to vary based on risk factor, right? So A is considered low risk with a low amount of kind of management and just safe, right? Safe. We've got typically a new building or very nicely remodeled building. We've got area classifications and building classifications. So I'm just going to talk like they're the same right this second. So I might have a really nice area with a nice new building. That's an A. That's very low risk profile. We don't have a lot that's going to go wrong right away. It's brand new. Things are still under warranty oftentimes with the contractors, all that kind of stuff. We've got our B class that's going to be a little bit older, that 1980s, 1990s, maybe early 2000s. And then we've got a neighborhood that's, it's working class. It's kind of your middle management, lower management, but still, high-ish paid jobs, I guess, middle class. And then you've got your C class, which are typically older buildings, 1970s, 60s, 50s, and so on. And then you've got, more like the laborers, maybe some government assistance, that type. And then you've got the D class, which are going to be, a lot of government assistance, people in and out of jobs potentially, high risk, I guess, tenants that maybe have major credit problems, crime problems, crime history, that type of stuff. And then of course, very old product. So it's all based on risk profile, right? And it really varies depending on the market of where the cap rate flow goes. Sometimes you might see an A class at a 4.5 cap, and a B class at a 5 cap, and a C class at a 5.5 cap, and a D class might be at a 6 cap. But other markets are more spread out than that. We might have a 4.5 for our A. We might have a 6 for our B. We might have an 8 for our C. And we might have a 10 plus for our D. So it depends on the market and where you're at, how tight and competitive it is, to determine the spread of the cap rates. But there's always going to be a spread. And if there's not a spread, and the tighter that spread, the more you should be looking at potentially going to that A minus type property. Because again, the risk profile is typically less on an A minus property. Hey, let's take a minute to thank our sponsor, Pine Financial Group. Look, you work hard for your money. Is your money working hard for you? Because of inflation, money sitting idle erodes your wealth. Many investors understand that real estate is a great investment, but may not want the effort or the risk that comes with owning their own property. They want to sit back and have payments, hit their bank account each and every month. Stop eroding your wealth and start building it by asking your money to work for you. You should be earning profits while you sleep, an investment backed by real estate. Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, was recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through the investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. There's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. It's www.pineinvestments.com.
And how much do cap rates vary depending on the market in the United States?
Wildly. I mean, you go into a market like San Francisco, for instance, and you're going to see, I don't even know their cap, so I'm just putting numbers out there, by the way. So if you're from that area and you go, hey, you're way freaking off, I'm sorry, I probably am. But let's say San Francisco, you're going to get your A class property for a, let's call it a 3 cap. I mean, I know it's low. I don't know exactly again, where you might go to a Cleveland, Ohio, and your A class, again, I don't know Cleveland cap rates either, so I might be off on this, but your Cleveland cap rate might be at a 6 cap. And their spread, I know this is a fact in both markets. San Francisco's spread between an A and a C is not that big of a spread. You might be at a 3 for an A, and maybe for a C you're at a 4 or 5. Where in a market like a Cleveland, you might be at a 6 for an A, and you might be at a 10 or 12 for a C. So you got a bigger spread there. Definitely on the markets. Typically, the tighter and the more competitive the market is, the tighter the spread between the classes are going to be.
And what sort of cap rates do you look for in the properties that you're considering?
Yeah, I mean, it goes back to just what we talked about earlier. It depends on your strategy. So my strategy is a value add strategy. So when I go in and look at a property, am I looking at cap rate going in? I'm not looking at what I'm buying it for on the in. I'm looking at where my exit is, and is there enough equity that I'm creating to create the returns necessary for my investors to where I can sell it at a cap rate that's, consistent enough. So, let's just say I got a market cap rate of a 6. I want to make sure after my value add, I'm definitely higher than a 6, right? I got to be, probably closer to a 7 after my value add, maybe even higher. So I have some equity to be able to play with when I sell it. I want to make sure I'm not upside down after I do my value add, after I do my renovation. So I know it doesn't really answer your question, because that's not how I look at it. So again, cap rates are really important, but they're only one determining factor on whether my project's going to be successful. I do still look at cash on cash returns. I look at overall equity multiplier, meaning, how much money I put in there, what am I multiplying my money by? So if I have to put in $1 million in 5 to 7 years, can I get 2 million out of it? I look at my internal rate of return. I'm looking at the risk profile of the property. Overall cash on cash, all that, the strategy behind it, whether we can complete it or not. I mean, I'm looking at a lot of different factors.
And you're, for our listeners, the value add, by adding value to the property, you're either, increasing revenue or decreasing expenses,
or both,
or absolutely both. And then as a result, the value of the property increases, and then if you're and your cap rate might increase or stay the same based on what you're going to sell it at.
Yeah, I mean, look, if you can increase your rents by $100 a unit, um, you can create a ton of value right there. You can just instantly you're printing money basically, right? And so that's the power of doing a value add. Um, so what I want to shift though to where cap rates have been, where they're at right now, and where I think and we think they're going. So let's shift to that.
So you talked about this a little bit already during
Yeah.
the recession, 2007 to 10 or so. Where were cap rates then?
Well, I mean, much higher, right? So I don't. Again, it's very, very market driven, but probably 100 to 200 basis points higher than they are right now, and potentially even more depending on the market. So, you might be seeing a market where your B class property is selling at a 5.5 cap. And back in 2010, that same B class property was selling for a 7 cap. And those are very real numbers. I mean, that's absolutely how things have been. So we're probably anywhere between 100 and 200 basis point difference in most major markets on class by class value difference.
And then how about before the recession, in the years leading up to it, where are the cap rates then?
Yeah. So, I mean, and that's what something important to be kind of looking at is where they've been. So that is not quite as drastic, but you're probably anywhere between 25 to 100 basis points difference between from last peak to right now, where last peak you might, B class property might have been at a, let's call it 6, and now it's at a 5.5. Maybe it was at a 5 3/4. Now it's at a 5.5. And again, it's going to vary depending on the market, but like take Minneapolis, for instance, we're about 50 basis points or so different than the last peak. Our cap rates are lower, which means properties are selling for more based on the income.
And like 100 basis points is 1% or one cap.
Right. So yeah, 100 basis points would be going from a 5 to a 6.
Yep.
Yeah.
And how about now? What do you see the normal cap rates as right now?
So what do I see now, or how am I reading where they're going?
Where are they now? And then after that, where are they going?
Yeah, I mean, we're the most compressed we've seen really in our history. I mean, we're as compressed as it's ever been, and or equal to or more compressed than it's ever been. So that's what it's at right now, and that's just reality. We've got a very kind of tight money market. Everybody's looking to place money, and so money is getting or interest rates and expectations are getting tighter, and overall real estate is seen as a very viable financial option, where before I don't know that it was as much. It was more of a niche market, where I think right now it's not nearly as niche as it's been, and it's much more institutionalized. So that's, I guess, some of the factors of why we're seeing these compressed cap rates.
And do you think that they're going to continue to become more compressed and smaller, or what do you see in the future?
To me, all signs point to not much change in it. And I know that's dangerous to say, because we go, well, there's always market cycles. And I do definitely think real estate is going to have a market cycle and market correction. But I think the overall trend, and now what might happen is we've seen these cap rates go from, where they were down to this 5, call it a 5 cap, whatever. So from a 6 down to a 5, what might happen again is In the next correction, maybe we go up to a 6, where the last correction we went up to a 7. We might go up to a 6, but I feel like we're going to come back down very quickly, and we're going to be back to that 5 and maybe even less. I feel even if a recession happens, that overall, we might see a blip in the radar, but overall our cap rates are staying compressed. They're staying low. I think there's a couple reasons for that. And I'm not convinced that even a recession is going to change the cap rate very much as far as it going up too much. But I think there's some factors that play into this. I think, first of all, our money, there's so much money out there that needs to find a home that has interest. Okay. That puts downward pressure, supply and demand. I think we're in a global economy, I know we're in a global economy, something we've never really seen before. Look at the last recession in the economy and the recessions before it. We've never been in such a big global economy before. Canada just increased its purchases in U.S. real estate, I think, by 176% from a year ago today.
Wow.
Or last month or whatever the statistic was from. Middle East increased by 48%. Now, some markets have decreased. Europe overall has decreased. Asia overall has decreased. But we're in this global economy. People look at U.S. real estate as a very safe investment. And we've got yet the highest cap rates of, I think, of all developed countries like us, countries that we would say are on a fairly equal playing field economically as us. So when we look at that and we go, okay, China has cap rates, like 0. Asia, most of Asia are in the low single digits. Canada's definitely lower than us on their cap rates. 3-4%.
Australia is really low.
Australia. I mean, when you look at that and go, okay, their cap rates are so compressed and we got this global economy, that's why I think it's going to stay low. The other thing is, I think interest rates, I don't see them going up. I mean, we've been talking about interest rates rising since I started in real estate back in 2008. Interest rates went down very quickly, and they're talking about them going up, and they've just continued to go down with a couple little ups, but mostly down. So I don't see that changing. I think we're going to keep these low interest rates. Again, we have some of the highest interest rates in all the developed world. And so where's it going to go? I think overall, with all the things that are going on, we have compressed cap rates here to stay for the long-term outlook. The other thing too is real estate is, I already said it, real estate is becoming more and more institutionalized. And when I look at it, even throughout all asset classes, commercial, most of commercial, industrial, retail, that has been, nice with your cat. That has been institutionalized for a while here and becoming more and more. But the multifamily is really shifted since the last recession. Mobile home parks and self-storage are really seeing a lot of institutional money be attracted to them. So it's just becoming more and more institutionalized, which ultimately drives down cap rates. So if that answers your question, I think they're staying still, or maybe even going down.
I mean, that's good because, if there's at the same or similar, then there's a lot of stability in there. Better projections on what you can expect in the future.
Yeah, it's good and it's bad, right? I mean, it's good if we see stability because we know then how to underwrite. The problem is, do we know truly this is going to be stable? We do have some things that are some wild cards, with the economy is always a wild card. Potential potential wars are always a wild card. Donald Trump is a wild card. The Democrats fighting with Donald Trump and the Republicans, all that divisiveness. That's a wild card. I think the political environment overall, I would say, is a wild card. So there's things that are completely out of our control that we just can't control. And we probably can't really get caught up too much into. We want to be educated in it, yeah, but we can't get too caught up in it. Those are still out of our control. So I would love for real estate to take a hit and have opportunity, because I would love to be buying a lot more real estate, but that's just not where we're at. And I don't see massive changes coming. And even when they do, like I said, I just see, sure, a change will happen. Real estate will have a cycle, but I think overall we're stuck in this low cap rate environment for the long term. And a recession might raise it, but that's a temporary thing. We're stuck down low for a while.
Okay.
Yeah. So that's it. Any other cap rate questions? Any more brain busters for me?
One last question. So I know you're focusing on value add properties. I also see a lot of building going on. A lot of new properties being put up.
Yeah.
What are the cap rates on new builds versus value add?
Yeah, I mean, typical new build's going to be their cap rate. Well, it's hard to say because the cap rate's based on a sale, right? Not just an acquisition. So when you're looking at if they were to sell that property, they're going to sell very similar to what any other A-class building is going to sell for. Maybe at the high end because it's brand new construction. So if the market's bearing a 5 cap, they might sell at a 4 3/4 to a 5 1/4 cap, somewhere in there.
Okay.
Yeah. Now, what are they all in at? Well, hopefully, if they're building, their all in cost is less than if they sold it, so they could make some profit. So hopefully they're all in, and they're actually all in cost is a 5 3/4 cap when the market's going to sell at a 5 cap or something like that. So usually they got some margin there.
Sure, that makes sense.
Yeah.
All right. Well, that's all I got for you, Todd.
Cool. Awesome. Well, thanks, Matt. Appreciate it. For our listeners, would love to have your comments on cap rates, kind of what you're thinking, what's going to happen with that cap rate. Maybe you have different thought and philosophy than I do or Matt does. And so if you want to reach out to us, definitely do that. You can go on to Facebook and, reach out or make comments on YouTube as well. So.
Yep.
Awesome. That's all I got, Matt. Have a good rest of the day. Make every day a Saturday. Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.